Hello and welcome to the market update here for Tuesday, June the 6th. Let's get started. Obviously we're seeing a little bit of another mixed market day today. With, in this case, it's the Russell 2000 that's up pretty big, but the other indexes are lagging a little bit. We're dealing with a condition in the market that's getting a little bit stretched or overbought. You can see that the momentum indicator has gone all the way to the far right side. Now, just because it's over there on the far right side doesn't mean that a sell-off has to happen immediately or that a sell-off has to happen at all. Sometimes the market can move a little bit more sideways and just kind of consolidate a little bit and alleviate that overbought condition. And there is a little bit of evidence that it might be doing just that. That's unfortunate because you just got done with me coming out of a February and March, just totally complaining about the stagnation and sideways movement of the market. I don't expect it to get back to that, but it is showing some signs that it could be starting to move a little bit more sideways, and that may be just what happens to alleviate this condition. So we'll look for that. We'll watch for that. Again, I'm trying to look out to see what kind of triggers there could be. Obviously, next week is going to be a big week. You've got Tuesday, the CPI report comes out, Wednesday, the Fed meeting, and the PPI report comes out that day. So there's a lot of news that the market's going to be looking for next week, which could be a reason why we stagnate this week. Going into that, we started to move a little bit late last week, so I thought, maybe, we see a lot more volatility this week, but it looks like things are just kind of starting to move a little bit more sideways. And I think that's probably the market just saying, hey, let's wait and see what happens next week. There's really no big news items coming out this week. Although I say that sometimes and then something happens that and the market reacts to something it normally doesn't react to, but and maybe that's what it takes. I mean, sometimes that's why I don't have a whole lot of confidence that next week, although there's a lot of stuff coming out next week, that's actually going to move things dramatically, because we've been in that pattern the last several months where, okay, all focus is on the jobs report. The jobs report comes out, there's maybe a little reaction to it, and then all focus is on the Fed meeting or the CPI report, and you get a little bit of reaction out of it, but then it just stops and starts looking again to the next big bit of information to come out, and so at some point the market will not act as much that way. I mean, it's always news driven where it looks for the next news item, but it'll start to not be so focused on each of these meetings. But that's something to always pay attention to. The market will tend to focus on something. I've mentioned this before. I remember several years ago where it was problems in Europe, and everyone was watching the European exchanges every day. We were talking about how Europe was trading and what was going on there. I mean, when was the last time? I don't know. For me personally, I can't even remember the last time I checked to see what the European markets are doing. Not to disrespect European markets. It's just that there's so much to follow in the U.S. markets, and if the market isn't focused on something over there, then it's kind of a time thing. You can only have so much time in the day. I tend to not to worry about it. Obviously, if you're trading the European markets, that's your focus, and you're gonna analyze everything that's going on there. But the point is that the market will tend to fixate on things, and you need to pay attention to that. I'm not saying you get obsessed with it, because bottom line is, what is price doing? What is the chart doing? But the market always needs to have reasons why people are buying, or reasons why it's selling, and that's all I pay attention to are what are those reasons. I want to be aware of what those reasons are. But you're not going to try to trade off of the macro or the news itself, but more importantly, what the price is, what the chart does based off of that news. Okay. But right now we're in an overbought condition. There's risk that we could get a sell-off out of this, and so you want to be aware of that. Typically, if you're if you've got a lot of positions going on in a bull market condition, you would tend to tighten up stops a little bit when the market gets stretched like this. Try to avoid adding too many new positions when a market gets stretched. Not necessarily bail out of positions, but like I said, a lot of times it's usually just tightening up stops in case there is a bigger pullback that takes place. Or if you are reaching target points on your charts, or your individual charts are reaching an extreme reversal risk area, you could get out of some of those positions and build more of a cash position in case there is a little bit of a bigger pullback. So you've got money to add into the market on any sort of pullback that takes place. So that's kind of the way to kind of read that. Now, breadth is still lagging dramatically, and again, this tells us that it's just telling us that there are fewer stocks that are participating in the rally. We know this. It's not like it's any inside information here. Everyone's aware of that, and typically, there's two ways to look at it. I'll tell you the two ways, and then I'll tell you what normally happens. The two ways to look at it is that the leadership stocks have taken off, and that's the big cap tech stocks, Amazon, Apple, Microsoft, and all those stocks have kind of started the bull market, so to speak. And now all the laggards, all the other small cap stocks are going to start to follow those big cap stocks. And so we'll see the market take off and start a whole new bull market right here. That's one way to look at it. The other way to look at it is that it's only those big cap tech stocks that are holding the market up. And as soon as they roll over, there's nothing left to hold the market up. It's going to come crashing down. And so it's more of a negative thing. Now, one thing you always hear me talk about is that that the small caps, they tend to lead the way, and then the big cap stocks tend to come in behind them. So a more healthy rally is when it's very broad based, when there's a lot of stocks participating, and so. From a probability standpoint, it's more likely that these big cap tech stocks are holding the market up, and that there still could be some downside. Now, one thing that I think has been good with the rally that's happened over the last couple of weeks, if you remember a while back, I said one of the things that I kept talking about this panic sell-off, but one of the things I theorized is holding that back was there were too many people out there that were bearish, that were expecting the market to go lower. And it's hard when a majority of people are already expecting the market to go lower for it to go lower in any sort of dramatic way. Well, this rally has alleviated a lot of that. Well, there's two things that have alleviated that. The AI craze has caused people to, the fear of missing out, the FOMO. They're jumping into these things because they're afraid it's going to be the new internet, and they want to get in early. They want to miss out on it, and so they don't care where the chart is. They're just buying. Now remember, if you don't know why you're getting in or have a plan for your trade, it's an emotional decision, and you're likely to get shaked out of an emotional decision. Those are going to be the first people that sell heavy when there is a sell-off, because they don't know why they're there in the first place. And to say that they want to make sure they're in because it's the new internet, well, that gets tested pretty quick when there's a big sell. When the Dow's down 2,000 points and everyone's running for they're running for the exit. Like I said, if you don't know why you're in there, you're usually the first one to get shaken out of the trade. But the point is that there's been a little bit of a shift now where the market is turning more bullish, which sets the stage for a bigger sell-off to take place. Again, I'm not saying I see signs of it yet. There even some of the bearish reversals that have taken place in some of the big cap tech stocks recently have been kind of reversed. Amazon did that recently, and I'll actually take a look at some of those big cap tech stocks here in class. We'll take a look at those because again, when those start breaking down, then you know that there could be a stronger probability of a bigger sell-off. But that's something to really look for now too, with the market now stretched and in that overbought condition. A question here. Mute. Is anyone else having any problem hearing me? Someone said I don't have a mute button to mute anyone. Nobody has I don't have an open mic in the class. So if that's what you're commenting on, that's just the way I do my classes. If you have questions, I'll just make sure you type in the questions. But if you're not hearing any sound at all, I guess nobody could tell me if they can't have any sound. But I would imagine I would be hearing more people tell me. Can someone let me know if they're able to hear me? Just real quick here. I guess I should have done that in the very beginning of class, but usually I'll start getting a whole bunch of people telling me they can't hear me. So that person that typed me the question in, well, I can't even tell them because if they can't hear me, I was going to say to dial back in. If that ever happens, just dial back into the class. Sometimes that'll fix the problem. That's what I do. If there's an audio issue, I just dial back in, and usually that fixes it. Well, it sounds like everybody else is okay, and I just don't have the capabilities to kind of to try to figure out why that's the case here. I can't take up class time to do that, and it's recorded. So if you miss it, you can get the recording of it, and hopefully the audio issues are fine when you get the recording of it. So let's kind of keep going here. All right, so breadth is lagging. We're aware of that. And again, it could mean that there's a catch up, but more likely it's those leadership stocks. When they start to roll over, the market will probably start to roll over as well. Sentiment has also been extreme. We've been aware of that. Now the buy sell ratios are pretty close together. They're not showing an extreme condition yet. And this is what's weird is usually you're going to see the buy sell ratio showing a wide range. They'd show something like this, and that would line up with the momentum being overbought. Okay, but this is what the breadth is showing you though. It's showing you that there's basically just a handful of stocks that are really overbought. And that's causing that indicators to become really extreme there. So, it is weird to kind of see that. Normally you see all these kind of showing the same thing, but this is reflecting that lack of breadth and dramatically a lack of breadth. They're still really close together. The buy sell ratio indicator here. Now this other sentiment indicator is really extreme as well. It's gone, and normally when it gets to that red line, you see some sort of a sell-off. It can get above it, but it did get dramatically above it back here, but it's dramatically above it again. So this is, again, it doesn't mean it's going to happen immediately. And could it be that it just moves sideways a little bit this week and then it has more of a dramatic move next week? That's definitely a possibility as well. That's something we'll keep an eye on. But that is, we've got, again, that's, so the reason why we go through these indicators is they're each kind of telling you something different. And, but these early ones are just telling you, is it stretched one way or the other, overbought or oversold? And hold on just a second here. Okay, sorry about that. All right, so let's go into our charts. Now, so last week, and again, I was worried about this because Thursday I was talking about the jobs report coming out the next day. I didn't see how there was any reason or any way that jobs report could be viewed as bullish. But I still stand by that because really what's going on, and I have to pay attention to what the market does because it doesn't matter what I think it should do. The market isn't usually reasonable or isn't reasonable all the time. But it's clear that the market is ignoring the Fed. What I keep telling you, and I'm going to keep telling you this, is that the Fed is number one priority right now is to get rid of inflation. And in order to get rid of inflation, they have to see they have to get unemployment to go up. They have to change the behavior. People have to be afraid to spend, and there's not enough people afraid to spend right now. And so, what will happen is if because everyone keeps saying, well, look, we're going to have a soft landing. It looks like we're going to have a soft landing. The inflation's coming down, and then what's going to happen is the economy is going to take off again. And guess what happens as soon as the economy takes off again? Inflation's going to spike right back up again. And so then you've got to push this out another year. And this is what happened in the 70s. And it feels like, if that is what the Fed ends up doing and they back off, it's going to be the 70s all over again. And now I was a young kid during the 70s, so I don't remember the dramatics of that period. But if you looking back in history, it wasn't a very fun period economically for the country. And so that's what would happen. And so, you get this unemployment, everyone kept talking about, the unemployment's not, it's not being affected. Well, that means that the Fed's going to keep hiking rates. I don't know that they'll hike this meeting, and they may pause a meeting or so, but they're not close to cutting rates. I can tell you that right now. And the market is ignoring that. The market is just saying that they just don't believe it. Now, at some point, they'll have to, I would assume. But it's really funny how the people, when the Fed's cutting rates and people are telling you to buy into the market, and the reason they give you to buy in the market is they say, don't fight the Fed, don't fight the Fed. The Fed's cutting rates, that means that it's bullish for the economy, and it is. But when the opposite is happening and they're tightening, they fight the Fed. They say, keep buying. And their reasons are it's going to go up eventually. And, I'm not arguing that. I'm not arguing that markets are designed to always go up in the long term. And that's why most people out there are bullish. That's why most fund managers out there are bullish, is that especially if you want to take on a long-term approach, and that's your argument every time, well, guess what? Yeah, in 20 years, the market is going to be higher than where it is today. I can almost guarantee that, that's the way it's always been. But if that's the case, then everybody should just be put their money in to an index fund and then not do anything else. That's all you do, because eventually over time it should go up. But what about in the meantime? There are going to be ups and downs and bull markets and bear markets, and that's where the skill comes in to be able to trade and make even more money than those index funds over the different trends that take place. So to go out and that's why I get frustrated when people their argument is always, it's like Kathy Wood does this. Her fund came down, her ARK Innovation Fund. Sorry, I'm on a little bit of a tangent here, but that's okay. Her ARK Innovation Fund came way down. It had that big run up in 2020 during COVID, had this big drop all the way down, where it lost almost all of its value. And her argument was, well, these things are innovative companies. They're gonna make money, and they're gonna be big in the future, and they're gonna go back up. Well, Yeah, that might be the case. I would argue that some of them are probably going to go under. They're not going to be the ones that survive. Some of them are beaten up so bad that I just don't know how they'll survive much longer. But but the point is that yeah, I mean, yeah, if you hold on long enough, it'll eventually go back up. I remember Yahoo used to be a publicly traded company. It's gone private, I believe. But I remember it was a big mover during the internet bubble 2000. And when that collapsed, that bubble popped, it went like from a $300 stock to a $10 stock or something like that. And it did get back. Actually, it never got back to its all-time high, but it got back close to it. But it was like, I swear it was like 12 years later that it finally got back near where it was at that bubble high, And so, yeah, you can make the argument that eventually it will go back. But do you have 10 or 12 years for it to go back just to break even again? No. So that's the problem I have with, the argument that, oh, eventually we're going to go higher, or eventually it will go higher. Yeah, well, our job is to make sure we either don't lose money during these declines, or we make money shorting stocks or buying put options during these declines, and then ride the move up when it goes up again. Anyway, that's my soapbox for the day. My little rant for the day, so to speak. But getting back to hold on here, let me get back to our chart here. So anyway, we broke out above that range. I got off on the topic talking about the jobs. I was trying to figure out how I got off topic. But the jobs report, so the market had a positive reaction to the jobs report. It broke out. But where it's broken out to is important, because this is another area that I said to keep an eye on, is this previous high over here. Actually, let's go to a 2-year chart. This previous high right here. Now, I had theorized that maybe we reversed before then. We're still in an area where we could reverse before then. But if we break out above this area here, you do have to respect, at some point you have to respect the fact the market is still going higher and could continue to go higher. I keep talking about market has never bottomed without a major bottom without a panic sell-off and all those things. But I'm also well aware that the market will do the lower probability move sometimes. And if you ignore that could take place or could be taking place, if you ignore what's actually happening, that could be dangerous as well. The thing that would, if we broke out above here, you start to get into retracement levels you're getting pretty far up on the retracement level there. I'm going to go to my other charting service to show the retracement of that move. Let's go to a weekly chart here. Let's use the SPX because I have fewer lines drawn. But if I take a retracement measurement, that high right there is right at the 618 retracement level. Okay. When you get above the 618, and it's a 618 retracement of this move down right here. So at this point, you've retraced this move down 61.8%. You start to get above that, and the probabilities start to shift dramatically from this being a correction for another move down to this actually being an uptrend and going higher. Okay. So this is a real critical spot right here. From a retracement point of view. Now, can you have deep retracements that still lead to moves down? Yes, but the key point here is that once you get above here, the probabilities start to shift. Okay, and again, it just means you have to respect that. And by the way, this other area was right at that 50% retracement level, the area we've been looking at before. Also, while I'm here, remember what I was talking about on Thursday was the candle. I said if we were down at all on Friday, we would have had a bearish candle, a bearish weekly candle on the weekly chart. Obviously, the big surge on Friday changed that, but that's what we're watching again this week. Is do we get a bearish reversal candle this week? If we are down for the week, I think that is really bearish going into next week. But that's something to keep an eye on. I'll probably talk more about that on Thursday because I'll be closer to the end of the week at that point. But it's really pointless on Tuesday to focus too much on the weekly chart, the current weekly chart, that is. And again, I don't see things. We did have a little bit of a bearish reversal yesterday. Well, let's go back to. But mostly, I'm looking at these candles as being kind of indecision candles. It's kind of like a pause, but you see it kind of moving. It's moving a little bit more sideways here with its behavior. I'm seeing a lot of charts starting to do that as well, starting to drift a little bit sideways. And that's one way to alleviate that overbought condition is to just kind of consolidate and move sideways a little bit. I'm also watching. Let me go back to that 2-year chart, because there's a trend line right here, which is the upper part of this range, and it's lining up in that same spot right in here. I didn't draw that line the best, but it's actually really, I can show you on my other chart here. Lining up. I'm trying to get as many of these. So I want to get as many of these highs right there in that trend line right there. So this is a little bit of a move above it, but it's lining up right in that same spot right there. So that's the upper part of the trend here. Now that also means you can keep an eye on the lower trend line or trend range here. And actually, well, you could draw 2 lines. You could draw this one right here out that way. There's another one that seems to have more reaction, which is, this one right here. So you look for a break below. I'd look for a break below that trend line, to be honest with you, because if we dropped, it came back below this resistance area. Remember, we hugged it many times, so that's a pretty significant area, and that even extends out further too. If you break back below that and you break this trend line, there's a great chance you're going back down to test those October lows. Outside chance that maybe it just gets to this trend line and then bounces back up again. But those are areas that you'd want to pay attention to. All right, let's go back to the 6-month chart. So the Dow is lagging, pretty dramatically, or not dramatically, but pretty obviously today. But it did have it had one of the bigger moves up on Friday. A lot of the stocks were really beaten down. You saw the Russell 2000 have a big move up on Friday. So you did see a little bit of that more participation from it, but it stalled out pretty quickly. And that's, again, what we're looking at. Was it just a short covering event where people that were short those stocks felt compelled to close out those positions? You have to buy to close those positions, and every rally starts as a short covering rally usually. So I don't want to say, I don't want to dismiss any rally as it's just a short covering rally. But what you look for is, okay, after the people that are bearish on the stock get out, and they have to buy to get out, they sell first and they buy to exit their trades. Are there new buyers coming in? These are the people that believe that it's going to go higher. Are those people coming in to push it higher? And that's what we failed to see on these bursts, is there's not much follow through to them. And that's what you'd want to look for. Now, there hasn't been a big drop, so you're not seeing people jump and short heavily, which is a bullish behavior. You know, you're not seeing the sellers jump on. But that's how we want to see this little pullback here, how it develops. Does it look more choppy as it pulls back? Because this looks like a little bit of a smaller impulsive move up right here. To look more choppy as it pulls back, that would be bullish. It's probably setting up for another move up. Or does it really start looking more impulsive to the downside? It's just too early to tell right now on that behavior. The Qs mostly just showing buying exhaustion. You had a bearish shooting star candle yesterday that was preceded by an indecision candle on Friday. So you had the big move up. And what didn't really participate that much in Friday's move, it was the big cap tech stocks. A lot of them were showing bearish reversal candles on Friday. And then we have another indecision candle today that's lower. And again, we'll see, is this meaning it's starting to roll over? Too early to tell. It could just be a pause. Sometimes it just, it looks like it's reversing a little bit, then it takes off again. Here it looked like it was rolling over and then shot back up again. But it is showing a little bit of that buying exhaustion, especially yesterday, where you would have expected stronger follow through. Some of those tech stocks that people have been dying to get into, Nvidia, have pulled back. You'd think that if they're really hyper buyers, that they buy that dip immediately, and they may still be about to jump into those again and push them back up. But that's what you start to look for, is you start to see those start to break down. That's kind of what I'm kind of focused on right now. Russell 2000, you can see big move up today, a 2.5% move up today. But again, I get back to something I tell you all the time: mixed markets are not healthy. Whenever you see, a couple of the indexes are up, a couple of the indexes are down, that's not a sign of a healthy market. That tends to be more bearish. But it's not something you base a decision on. You don't make your whole trading decision off of that alone. But it should bring in some skepticism on any move, whether it's on any bullish argument or bearish argument when you see mixed markets taking place. So, and obviously we've had mixed markets and the market has still managed to go higher. So that's what I'm saying. I'm not saying you'd ever base a decision on that alone, but it is a little bit of a warning sign. A lot of times when you start seeing these mixed market conditions, they tend to precede these bigger sell-offs that end up taking place. That's the thing that bugs me sometimes, is that people will have a big sell-off in the market, and people will sit back and be like, they're blindsided by it. They're like, how does, I never saw that coming, or how did that even happen? Or was it came without any warning at all? And the reality is that almost every sell-off that I've been a part of has had very strong warnings ahead of it. Some of it started off as minor warnings. Hold on. Early warnings. And sometimes the market can continue to rally for months after you get those early warnings. That's why you don't just trade the early warnings. You just note them. You're aware of them. Again, we're aware right now of this looking corrected. This was impulsive down. This looks like a bearish ABC pattern, possibly setting up for another move down. That's an early, the fact that the market has rallied, but it's rallied in this choppy condition. Well, it's been doing that for months. Okay. So, I'm not betting everything that the market's going to go down just off of that alone. If I did, I'd be broke. But you tuck that away as a warning sign, and then the warning signs start to get, stronger and stronger. You start to get some bearish reversals in an overbought market condition, extreme reversal risk market condition. And that tells you that, hey, it could be imminent, it could be very close. And maybe that's where we're getting at here. Typically, I'd like to see momentum, breadth, all at the extreme reversal risk and sentiment ahead of a pullback, a big pullback. But that's why we look at these signals. Is that it's they're lining up, and a lot of times they do predict pretty well that a big sell-off is coming, and allow you a chance to get out of positions or get back to more of a cash position ahead of it. And like I said, if I see it really looking like it's imminent, I'll definitely point it out in class and talk about it. I'm not afraid to point those things out. Bond market is still kind of stuck in this range here, but this is what I was talking about with a lot of these indicators starting to move more sideways. We're already in the sideways range right here, but even the bond market, it shot up last week right up here, and then it's come right back down, but it's up again today. It's starting to move a little bit more sideways. And remember, we had this happen a while back where the whole market was moving real sideways, and we were in kind of this tight sideways range. All the different markets were moving sideways. The bond market was moving sideways. The commodities were moving sideways, and the dollar was moving sideways. Nothing was really trending in any strong direction. We're getting little hints that it might be getting back to that, at least hopefully just temporarily. But I would conclude the bond market is indecisive right now. I wouldn't strongly predict a trend direction there on that one. The long-term trend or larger trend has been sideways in that sideways range, and so until we break out of that range, that's really what the longer-term outlook is on the bond market. It's just moving sideways. Gold moved up a little bit, but it's been moving sideways in the last week or so, as you can see right here. Now, in the context here, with this move down, impulsive move down that went to a lower low right here, this consolidation would actually be more bearish, probably be leading to another move lower. Now, a lot of that could depend on what the dollar ends up doing. But typically whenever you see a stock moving sideways, you want to pay attention to the direction or the previous impulsive move before it was moving sideways. That's where it's more likely to go after it's done moving sideways. And so this might have a little bit more downside to it, which, remember, I've got this in the portfolio. So, but I've got my stop, and my stop's down here a little bit lower to where if I get stopped out, I get stopped out. Remember, I purposely put my stop down below this congestion area right here. And that's it. So it's not much of a coincidence that we're having a sideways movement in that same area. I mean, I'm telling you, markets will look at previous resistance, previous reversal points on a chart, and it'll react to those. That's why we focus in on them, because people are trying to find reasons to buy or sell, and when they look at the chart and they see congestion, they start to get indecisive. Just like we don't need to know why they were indecisive back here. It doesn't matter. Very often it causes indecisive behavior in the future again. People are like, well, why were people indecisive back here? Maybe I should be indecisive. I mean, human nature is human nature, man. We do goofy things. We do things that don't make sense sometimes, but a lot of times we think we're making those goofy decisions just randomly, when in reality, everyone's doing the same thing. And that's why group behavior is usually pretty easy to predict, whereas individual behaviors seems a little bit more random, but group behavior very often is very, very predictable. And I've always been fascinated by that, but That's how, and the stock market is if you want to study group behavior, it's one of the best areas to study group behavior. I mean, and probably one of the easiest areas to study group behavior. And that's why I love charts, is because the charts just reflect that group behavior, and they're not perfect. We can't perfectly predict things, but I mean, by now, hopefully you've noticed that stocks will tend to move in an impulsive corrective behavior. Impulsive up when it's trending up, corrective, impulsive, corrective. When it's trending down, you'll get impulsive down and then corrective, impulsive down, corrective. It tends to move in this fashion, and it's because that's the group behavior dynamic that's taking place. And like I said, it can't perfectly predict things, but it's pretty amazing that you start to at times feel like you know what's going to happen next. Well, when there's a lot of emotion in the market, it becomes easier to predict. When it's really complacent and there's not much fear or greed in the market, and the market's moving sideways, it's a little bit harder to at least in the near term, to predict things. But man, when it gets emotional, I feel like I know exactly what it's going to do next, and many times it does exactly what I think it's going to do next. That's why I like movement. I want movement. I want emotion in the market. Just for that reason, it becomes easier to read and predict. An example of that would be, let's think of regular human emotion. If someone's just staring at you in a blank stare, can you tell if they're happy or sad or angry or anything like? Can you tell what emotion they have? No, they're not. They're emotionless. But you can't read it. You can't tell. Now, if they're yelling and screaming, you don't even have to hear what's being said. I can tell from 30 yards away someone that's angry, right, by their emotions. They're very easy to read. Or if they're sad, they're crying. I don't need to know what they're crying about. I can read that emotion. But it's when the emotion is obvious that it's easier to read, right? The same with the stock market. That's why I don't like these complacent periods. It's someone just staring at you with a blank stare. I can't read it. And there probably isn't much emotion there, right? There isn't much emotion there, which is why they're not showing it. But when they start to show it, then you clearly can read it. And that's what I'm talking about. When the market starts to be emotional, it's so much easier to read what it's likely to do next or what it's probably going to do next. And we haven't had a very emotional market for a long time. And so now hopefully these things go in cycles. We've got to be pretty close to the end of this emotionless cycle because it's been happening way longer than any emotionless cycle that I've ever been part of. And so when it does, we're going to have these classes where it's like, it's going to be really fun because it's going to be like, we're going to talk about what's likely to happen next, and it's going to do it. And you're going to be like, wow, this is cool. But you need that emotion to be able to read it, and we just haven't had it for a while. All right, U.S. oil again. Look at the oil chart. We talked about this being a bearish ABC pattern. We did get an impulsive move down, but then we got an impulsive move up. And then it's down again. So we're stuck in this little sideways range here. Now it could still be all part of the same correction. You had this bigger move down. Maybe this is just the choppy correction that leads to another move down. Who knows? Or maybe it breaks out higher and starts to move above that 618 retracement level where it actually looks like it's now trending up again. The bottom line is that it's stuck in the sideways range right here. And I don't think that's a coincidence when we look at some of these, the bond market and all these other markets that are kind of doing the same thing. The dollar, we talked about the dollar hitting kind of an extreme level. When it caught up to this area up here, we said that's probably an area where it could pull back. It did. Now this is a dramatic candle right here. This right here is what we call a bad tick. Whenever you see a really long tail like that, in most cases, there can be a case where it's a very thinly traded stock where it did actually trade down there because someone didn't use a limit order. They used a market order or something, and they got a really bad price. But typically, because this doesn't show up on it's on my other charting service. It's already been cleared up, and this will eventually get cleared up when this gets updated. But you just have to ignore this right here. Let me show you on my other charting service that it's not there. And this is why it's nice to have a couple different charting services. If you ever see something like that, you can double check it on another charting service. But it's still showing up on mine. So this will disappear. If I go to the actual dollar index, so here's the DXY here. See, it's not there. So that was a trade. That was a bad trade on the UUP, the ETF for the dollar. That'll end up getting, probably is a canceled trade. It'll probably end up disappearing. But you can see it's not. This is a clearer picture of what the dollar looks like right here. So it did pull back, but it's probably just a little bit of a pullback within the within that uptrend. At least that's what we're looking at. Is it just, was this just wave A, wave B, wave C, or was this the pullback and it's just going to keep going higher? The bottom line is the trend is still up. It's still acting like an uptrend, and that would tend to be a headwind for commodities like gold and oil and things like that. The VIX, this is another thing I told you that is really hard for me to kind of square up. Can the VIX the VIX is down below 15 now. Can the VIX, it's almost down below 14, and they get below 14, who knows? Now, again, can the VIX trade below that? I'm not saying it can't trade below 14. I've never said that. But can't remember a time I've ever seen the VIX below 14 that wasn't in the mid to later stages of a bull market. And that's what we had back here, 2021 to 2022. We did get some readings, but even then they were barely below 15. There was a couple times where it was barely below 15. You go back to right before the COVID bottom, we got some readings all the way down to below 12 here. But remember, where was this? Where was 2018 up to the COVID bottom here? Well, let's look at that on the SPX. Let's look at when were we getting those VIX readings? It was right. Look at that. Look at this bull move right here. It was right here at the very end of that long, huge bull market. And so that's why I don't understand the VIX being down this low. And again, the market is not taking off. It's not in any sort of a impulsive move up. It's in a corrective move. Now, again, maybe something's going on here that I'll learn about, and it'll be something that it'll be force me to have a different way to read the VIX, or maybe not even use the VIX anymore. But the VIX I'm telling you, has helped predict so many moves for me that I'm just conditioned to that's why I use it. That's why I show it to you guys. And by the way, remember, it's a very complex indicator to use. You got to be careful. You never want to make it the primary indicator. I'm not going to go short something just because the VIX is down. Okay. Or buy or short something just because the VIX spikes up a little bit. Okay. But I talked about this a while back where I said that every time the VIX got down to these low levels, what has happened in the market? When we got down to 16 right here, what happened recently when that happened? Well, we got this pullback right here. Hold on. This pullback right here, and this pullback right here. So it didn't lead to some massive drop, but nothing. It's very hard to know when a massive drop is going to happen. All you can usually notice is that a drop is about to happen. Then the only question is, does that lead to a massive drop or just a average drop? Okay. But the VIX was signaling it here and here. And now we're up here and we're even lower on the VIX. We don't know what it's predicting, but this is where I wouldn't be buying in with the VIX this low, because you're probably going to get some sort of a pullback out of that. Now, maybe all it does is pull back to this breakout area right here. That's fine. And if it does and it starts to reverse, then we'll look at some things to add in the portfolio at that point. But the VIX this low in these conditions, what it feels to me is it feels like a coiled spring that's getting ready to explode. That means a big move. And with it down this low, that big move is much more likely to be to the downside. Again, nothing new that haven't been telling you for weeks, but something big is about to happen, and when it does, hold on here. When it does, we can look back and say, oh, that's what the VIX was telling us. It was pointing this out before it happened. Hold on just a second here. Question is, isn't the Fed talking about a skip in June? They're not talking as much about it. There's a lot of people that are suggesting it, and that may be the case. I don't know I don't ever try to figure out what they're going to do, but I do know that they want to make sure that they're not going to lower rates until unemployment gets up much higher than where it is, and it could be that remember, it's such a lagging, when you raise rates, it's such a lagging thing. Maybe we're going to get a big unemployment reading, one of these months that is finally showing the damage that the raised rates has finally done. That could be something that happens. One of the things that's hard to read too is I don't think we've ever raised rates this quickly. This many rate hikes this quickly, at least as far as I understand it. I don't think that's ever happened before. I could be wrong, but it would probably have to be. I don't know. I don't, because we never had this bad of inflation since the 70s. So I don't think I've ever remember, at least in my trading, that ever seen the rate hikes this dramatic. So there is a little bit of the effect of, we don't know what happens when you raise that quickly. Do you all of a sudden just see it, a massive drop or massive rise in unemployment, massive slowdown in the economy all at once. So I don't know what they're going to do, and I don't think the only way I think it matters for us as traders, because again, we're not going to base our decisions on fundamental stuff. At least I don't. But the way it could affect us is just, if nothing gets done, then all the focus is going to be on the July meeting, and it just, you get a stagnant market until then, because then if they don't hike again, you could have people that say, okay, we're done, and now we start predicting when they're going to cut. Anyway, so I think it just postpones the market. I wouldn't like that, just because I think it would cause more stagnation. I'd rather see movement. But I don't know. I don't know what they're going to do next week. I will say I haven't heard, at least as far as, and again, I don't follow this stuff. I don't listen to every Fed speech. Um, that would be boring unless I need to take a nap or something. But I don't remember any of the ones that vote. There's been a lot of them that don't vote that have said that they'll probably pause, or they've made statements that they should pause, or things like that. I don't think I've heard a lot of the voting members really coming out saying they're going to pause. So I still think that's kind of up in the air. We'll see. It could be just that they were going to wait and see what that. Remember that CPI report and the PPI report comes out before the Fed announcement. CPI comes out on Tuesday, PPI comes out Wednesday morning, and then it's the afternoon that the Fed decision comes out. So now I think that those Fed members know what those reports are going to say a little bit ahead of time. It's not like they're saying, the morning of the Fed decision that we got to see what the PPI report says before we got to wait till that's released before we make our decision. They probably have a pretty good idea of what it's going to show, or they might even have the data itself before it comes out. But that might have an impact. I think the jobs report last Friday had an impact, so they might have been thinking of pausing before, but I'm telling you, that jobs report was unexpected. Okay, so that could affect that would make me lean more towards them hiking this meeting. And remember, they're in a quiet period now, so they can't talk, or you can't get any sort of idea either way of whether they're leaning one way or the other ahead of the meeting. So we'll see. I try not to get too focused on binary events like that, because it feels like an earnings report where you're trying to predict what the stock's going to do after an earnings report. It's just a coin flip most of the time. All right, SMH could just be a pullback within the trend. This could be A, B, and C. I would like to see it come down a little bit further if it is just still a correction, but and you look at stock like Micron, it looks like it's or not Micron, NVIDIA. See, it looks like it could come down a little bit. This could be wave A, wave B, but wave C usually doesn't end right at the end of wave A. Usually it comes down a little bit further. So I would think that maybe the chip stocks might have a little bit further to pull back in the near term, but it could be part of a larger bullish correction. We'll have to keep an eye on that. All right. Real quickly, I did want to just peek at the mega cap tech stocks here. NVIDIA, we already looked at that chart, looking like it's pulling back a little bit. Microsoft, again, none of these are showing major reversals yet, but a little bit of an early sign of a reversal. But we saw that back here as well, early sign that pushed higher. But if you combine the two, early sign of a reversal, pushed a little bit higher, but then immediately started to show signs of reversal. So this is showing buying exhaustion, and we're seeing a lot of that. But that doesn't always mean that it's got to sell off. It just means that buyers have to find another reason to buy it to push it higher. Pretty much everyone that wants to own it right now owns it. And that's why you're seeing it stall a little bit. But that doesn't mean that some news couldn't come out that gives people, new buyers, a reason to chase it and get in right here. And that's why you don't just short because of buying exhaustion. But it is a signal. You want to be able to recognize that behavior is taking place. Apple had its major reversal. Now, this also coincides. I don't want to pull out the long-term chart, but the all-time high, it did briefly get above the all-time high yesterday and then closed lower. Bearish engulfing pattern, down a little bit today. Buyers are bought off the bottom here. So there were some buyers that pushed it off the bottom. But this is a bearish reversal signal. again, these candles are very short term in nature, so it doesn't necessarily mean that's going to lead to a bigger drop, but you're definitely seeing a little bit of a crack in that. AMD, so AMD had impulsive up, a little bit of an impulsive move down, and this is more sideways. So we'll see if this is A, B, and you get wave C coming down. But it doesn't necessarily have to do that. This could have been the pullback, and it might try to push higher. But if it does, from this standpoint, from where it is right now, it's already pretty stretched. So I would imagine that it would start to stall out if it got above that previous high right there. The fact that it got up here, this is off the NVIDIA earnings, it rallied a couple more days and then immediately reversed back down, tells you it pretty much is at the limit of buyers. Not a lot of new buyers coming in right here, but like I said, that can change if there's a new reason to believe it's going to go higher in the near term. But it also tells you if there's any reason to believe it's not going to go higher, it can come down pretty fast. So that's what you're recognizing with that type of chart behavior. It's getting vulnerable. So these stocks are getting vulnerable. Google consolidated a little bit right here, did move higher today. I don't see any exhaustive sign necessarily, except for it's moved. I mean, it went parabolic through here, but it did consolidate a little bit right there, and that alleviated the overbought condition. See, that's what I'm saying is it got up in this extreme range on this move up right here. It doesn't need to come down to alleviate that. It could just move sideways for about 2 weeks there, and that pushed it back, alleviated that. I don't see any strong candle yesterday or today to indicate weakness yet, but keep an eye on that one. If that one starts to show up, in the next day or two, make a note of that. Amazon had a bearish shooting star candle right here. I mean, that's a textbook in the right context too. And it did come down a little bit the next day. It did open lower off of that, but it's gone right back higher again. Now it had a bearish candle here that didn't last very long, another bearish candle here. So those are a couple signs that you're seeing signs of some buying exhaustion. But today's candle, unless it really backs off the high today, it's not showing any extraordinary weakness yet. So we're starting to see cracks in these mega cap tech stocks, but not strong reversal signs yet. An indecision candle yesterday, it's fought to go higher, but it hasn't been able to get above yesterday's high. We'll watch for that. That could be a sign that it's topping out a little bit. That's a pretty big run in Tesla there. So it's still a little early, but we're starting to see that buying exhaustion on a lot of those stocks that have been holding the market up again. Okay. All right. Real quickly, I got to wrap up. We'll just do one stock out of computer technology. Let's do this. DERX right here, 96 strength rank. What I like about this one is it's pulled back a little bit right here, then had this little impulsive move up, and then it's moved a little bit sideways. Kind of a little mini cup with handle pattern right there. You could wait for it to break out higher or wait for it to break out above here as additional confirmation. That looks like a nice little pattern there. All right, that's all I have. So overall, to wrap things up here, market showing a little bit of buying exhaustion. Not enough to really say that the market's going to pull back, but it is overbought. It is stretched, so it's in a condition where it is gone up a little bit too far, too fast. We already saw those sentiment indicators and the momentum indicator reaching that extreme range. We're seeing some of that buying exhaustion in the stocks that have held the market up. So we'll see how things look on Thursday, but I wouldn't be chasing this right now, chasing the market here. It still could go higher, but I would wait to see if it pulls back a little bit and gives you a little bit better entry point. And then who knows, if it is that coiled spring, we might be getting closer to a bigger sell-off. I don't see it yet, but if I see evidence of it on Thursday, I'll definitely point it out. and we'll kind of go from there. All right. Thanks, everyone. Have a great week. We'll see you on Thursday for the stock specific class. Bye now.